Good morning. Today is Wednesday, August 19th, and thank you for joining us for another edition of the Market Commentators podcast. My name is Andy Wilms. I'm president and CEO of the Milwaukee Company, and joining me this morning once again is Mike Wilms, who is our Chief Operating and Compliance Officer. Quick reminder that nothing in this podcast should be construed as investment advice, and the views expressed by Mike and myself are our personal opinions and should not be regarded as those of the Milwaukee Company. And with that out of the way, I'll say to you, good morning, Mike.
Morning, Andy, and good morning, everyone else.
And hope all is well up there in the Minocqua.
Well, let's hope. I mean, I've got my scheduled visit from Frontier here to kind of get the internet sorted out, so it's a big day, so to speak.
I know you have some problems with connectivity, as we all have on time from time, so hopefully we can get through the podcast smoothly and Frontier is able to address your problems going forward. Anyway, let's begin with a recap of what happened since the last time we talked. Uncertainty around this coronavirus stimulus bill was a dampener on the market last week, and lawmakers hit a stalemate on negotiations, and I believe have returned home now we're planning on returning home until after the Labor Day holiday, until Nancy Pelosi called them back in to deal with the post office.
Postal Service.
Yeah, that's the last I heard. Have you heard anything about them coming back? I mean, my understanding is they're still coming back this week.
It was my understanding they're supposed to be back for a potential vote on Saturday.
Yeah.
And they've teed up a mini stimulus bill of about $500 billion without the $1,200 checks to individuals. That kind of looks like a dead on arrival proposal, but I just don't know what to expect out of Washington.
Well, I think that nobody does at this point, and that's been kind of a drag was kind of a drag at least last week on the markets. I think investors kind of adapted to the new normal, and but last week, while the Nasdaq was flat and the S&P was up 0.5%, the Dow rose by nearly 2%. As traders seem to be shuffling money from major tech stocks like Facebook and Amazon to the so-called reopening names that were cheaper, like United Airlines and Gap. But meanwhile, the value sectors continue to struggle, including the financials. This week, it's been the trading volume was light on Monday. So not much happened there, but the Nasdaq did rise by about 1%. And then yesterday, kind of historically, I guess, the S&P broke above its all-time high, recovering all of its coronavirus sell-off losses or declines. And the Nasdaq also hit a record high as well, but the Dow lagged a little bit yesterday. In conclusion, I guess I'll say the S&P is up now over 50% over 100 trading days, which makes the rally the strongest in history. And it appears that the shortest bear market ever has come to an end. We'll have to wait and see where we go from here. And a lot of where we go from here will depend on what happens with the COVID-19 pandemic. And do you have any news for us on that front?
Well, several things. I mean, and that's really a great lead in. I mean, Notre Dame is going to all online classes after just a short return for the on-campus students. And it's really hard to tell what the infection rates are going to look like and what level of control we have with the spread of the virus. One of the things that's been pretty well covered in the media here recently pertains to herd immunity in that regard, and the world population developing a response naturally once people have been exposed to the virus, where the original thought was 70% of the population would need to be exposed and either had the infection or developed antibodies against a future infection.
Well,
That
that's
number
it.
that number continues to drop.
Right. I think it's
So
down like 45 to 50%. Or, if you had that many people treated with the vaccine, that would also, you know, get you to that herd immunity, right? So
exactly, and that's kind of where the efficacy rate for the vaccine has dropped, where Dr. Fauci had talked about it was a low probability of a 98% effective vaccine. The FDA has made it clear they would approve it at a 50% efficacy rate. So, and the goal, the reason the herd immunity is important is once it's established, there aren't enough new potential carriers for the virus to continue to replicate. So the sooner the number of candidates for infection drop, the sooner the likelihood that the virus kind of dissipates down to an infection rate like some of the current strains that are in the standard vaccine.
well, let's hope that happens sooner rather than later, because CNN, as you may have heard, now reported that COVID-19 is the #3 cause of death in the United States, just after heart disease and cancer. So, have you heard about this new saliva test that's being promoted? Anything
Yes,
about that?
I mean, and that the news story started to come out that was developed in conjunction with the NBA and Yale University doing the research, and it allows a doubling of the testing capacity of the labs, a 3-hour turnaround so that you can get a test result while it's still clinically helpful. If you don't get the test results back for 2 weeks, the potential for the disease to have run its course is already come and gone. So the test is done by spitting into a tube. The tube doesn't require a preservative. It just needs to be kept warm, and a normal lab can do 90 different tests in an hour. So
Get the results, I think, in like 3 hours. And
it results in 3 hours exactly.
So it's dirt cheap to get done. So it would be pretty ironic if the NBA did more for combating this pandemic than all of Washington, D.C., or all of our governors and everybody combined. And it's starting to look that way, because if you think about it, it was the NBA that really, when they just pulled the plug on the season, that was really what set everything in motion to start, all of the social distancing and shutdowns and everything else. That was kind of the forerunner to it. And now it looks like it's going to be the NBA that developed, a saliva, not they delivered, but a saliva test, a simple, easy way to test for this virus was developed in an effort to continue the NBA season. In the what do they call bubble, and so those guys are really doing more for this fighting this pandemic than all of the politicians have combined, it seems to me. But anyway, I'll get off my soapbox. I feel about politicians on both sides of the aisle. I'm not their biggest fan, but
every now and then.
Yeah, what the heck. But let's talk a little more facts about let's look a little bit about the economic update. And last week, the Labor Department announced that unemployment claims fell below 1 million for the first time since March, and continuing claims dropped by more than 600,000 to 15.5 million. Those are still big numbers, but it's certainly a step in the right directions. And the job openings report showed job openings increased by 500,000. So that means people are looking for new workers. So that all seems.
And that's kind of an interesting statistic, the JOLTS report, where, I mean, it's one of the newer data sets that the Bureau of Economic Analysis tracks. For the first time, there were more job openings than unemployed people in March of 2018, and it had been tracking where there was over 2 million job openings versus the number of people looking for employment here at the start of 2020. So, I mean, what we're looking for is that that growth in job openings to accelerate here and kind of close the gap again.
Exactly right. That's what we're hoping for. And another positive sign came in the form of retail sales, which jumped 1.2% in July, and that was the third consecutive month of gains. However, this expiration of the $600 supplemental unemployment benefit is probably going to impact that. We'll have to wait and see, but there'll be less money in people's wallets to spend.
Walmart released their earnings yesterday and made that very point that they expected a sales slowdown with the expiration of the $600 unemployment weekly benefit from the federal government and the stimulus checks.
It was interesting to me when you talk about Walmart reporting yesterday. Both Walmart and Home Depot had just knocked the cover off the ball in terms of their results, and yet their stocks both were lower yesterday. Yeah, pretty shocking.
And so, same kind of results today from Target and Lowe's.
Yeah, so you have to start to wonder if the market really people are starting to get worried about these high valuations, which kind of brings us into our first topic, I guess we can start in, that despite the pandemic and, double-digit unemployment, the S&P has reached a new high yesterday. And what do you think is making investors so bullish? Do you have any thoughts about why the market's been so strongly as of, up to this point?
Well, a lot of the rhetoric has been around the need for an additional stimulus package and how that would help the economy. Very quietly in the background, the Federal Reserve continues to buy treasuries and mortgage backs at a rate of 80 billion in treasuries, 40 billion in mortgage backs. And if you look at the excess reserves on the Fed's balance sheet, that's the money that the banking industry, the deposits that they've collected that don't have a home in the form of new loans being made to individuals and businesses. That number has started to come down from a peak of $3.2 trillion to 2.7 here just recently. So that money is kind of finding its way into the asset markets, whether it's stocks, bonds, real estate. And I think that's got a lot to do with some of the fear of missing out investor responses here, where people continue to put money to work because 1 basis point on your money market fund isn't really very attractive.
I think that's exactly right. One of the big reasons, I think you're right, the Federal Reserve, basically printing money for the foreseeable future. Investors don't really want to be in cash or bonds, which are steadily potentially going to lose value. So where else are they going to put their money but the stock market? So it's the only game in town is, I think, one of the causes. I think it's also because markets tend to be forward-looking, or supposed to be forward-looking, like 12 to 18, where the economy is going to be 12 to 18 months from now, and not where they look tomorrow. I think investors are betting on the vaccine, right? They're confident that they want to be invested in the market when the news comes out that if there is a genuine vaccine, on the assumption the market will even go higher. I'm not so sure. I think the fact that Home Depot and Walmart went down yesterday was after their good news came out, could be kind of a precursor about the market's reaction maybe being much more muted to the announcement of a vaccine than some people are expecting. But I think that's part of it. And I think people are counting on more help from Washington. I think they're figuring that as dysfunctional as Congress has been, they're betting that somewhere, some way, the Republicans and the Democrats will find a way to keep plying the economy with stimulus. Then again, maybe not, because, let's face it, the people who are making those decisions are more worried about getting reelected than stimulating the economy. And again, there's a lot of political equations going on. That both parties are trying to think to themselves, I think, will a stimulus help us or hurt us? If we can say the Democrats blocked it or the Republicans blocked it, we can point fingers at them and convince everybody that this is their fault. they may come to the conclusion that that's more beneficial than actually passing a bill. I hope that's not the case, but that might very well be. So there are plenty of reasons for the market to have rebounded from the March sell-off, but that doesn't mean to me that there's any reason to believe those same reasons may not allow the market to hold on to its gains, if you follow my drift.
Yeah, no, and I would agree. I mean, so there was a couple of things that I was looking for at Walmart. The shelves are pretty empty, and you could very well have seen a sales blip higher, pulling future demand into the current period. And when we get to the future, it's kind of an air pocket.
Maybe you got that shirt you're wearing when you were at Walmart. Just teasing. Okay, not that.
This is a good color for me.
Yeah, it is. It is. I'm sure that's exactly right. Anyway, so as we talk about these valuation, the market values becoming so high, and there was a lot of talk last week about the so-called Buffett Indicator. Which takes the combined market capitalizations of publicly traded stocks and divides it by gross domestic product. And for the U.S., which Warren Buffett, has pointed to in the past, not saying as a really good way to know when stocks are overvalued. And last week, the global version of it passed 100 for the first time in February of 2018. And the U.S. indicator now stands about 170%, which is a historic high. So do you think that these, this is indicator and the many others that are indicating value stocks are high? Do you think the prices have risen to unsustainable levels going forward?
Well, I mean, I guess, the valuation metric that everybody is familiar with is earnings per share. And if you look at the current earnings per share number on forecasted future earnings at 22.6, that's the highest going back to the dot-com bubble. And we know how that ended, which unfortunately wasn't well.
Right. Well, the earnings per share thing isn't quite as disconcerting if you think about the fact that earnings are so low that even if that's going to going to push that ratio higher, right? Just because you're cutting the denominator. So when earnings come back, that ratio should should cause that ratio to drop
more like the historical average.
Right. But this indicator about these indicators, they do seem to suggest that we have to be very careful. And the Buffett indicator, by the way, you can make same sort of raise same sort of objections, right? Like GDP doesn't account for overseas income, U.S. listed companies that don't get in this, that, as you've talked about in the past, that's a big part of a lot of U.S. companies' earnings now.
Correct.
Overseas, and it's kept out of there. And but it has a very solid record. This indicator, the Buffett indicator, does have a very solid record of predicting past downturns, and it did spike right before the 2008 financial crisis. So I'm not saying it's reason in and of itself to bet against the market, but I do consider it to be another warning sign that current valuations may not be sustainable, and that earnings are really going to have to come up when the pandemic is finally resolved in order to maintain the market where it is or even push it higher. Okay, so I think that we talked enough about that. One of the other things I thought would be interesting, now that the S&P has reached all-time highs, the speed at which it has happened. Historically, since 1929, and we start there, the average time to recover from a peak to trough back to peak for a bear market has been around 26 months. We've just experienced that in just a few months, right? I mean,
that's almost 26 days.
Yeah, it's closer to, I think it's 33 days. I think it's 33 days when you count it all up. I think it's right around there, maybe a little more. But the point, 33 market days I'm talking about. But we've just experienced whatever, by whatever measure, the fastest 30% bear market recovery, from all-time highs in history. So the question I have for you is, do you think that this time's truly different and markets are, markets have changed, or do you think this is an anomaly? In other words, is this a sign of things to come, or is this a one-off type event?
Well, I am a proponent for reverting to the mean. So I would think that this time is different, and I would once again point to the Fed's punch bowl. It's unprecedented stimulus on the part of the fiscal spending and support from the Federal Reserve. So I think that's got something to do with how quickly the market has bounced back. I'm not so sure. We're hopeful that the fundamentals will justify this going forward. To your point on earnings improving. But that all remains to be seen.
Yeah, I agree. And, the hardest thing in investing is to know when things really have changed, when this time is truly different. I mean, sometimes it is, most of the times it isn't, but sometimes it is. And knowing, knowing which is which is probably the toughest thing an investor has to deal with. I think there might be an argument that market cycles will continue to happen at a breakneck pace, a much faster pace than we've seen historically. I think, the Great Recession planted the seed for a faster government response, a more extensive government response. I mean, the Fed is interacting and trying to direct the market in ways that you never could have imagined in the past. I mean, they really have stepped in to influence what the market's going to do in a tremendous extent. We have technology, that's speeding up the flow of information and breaking down the barriers to get into markets. You've got two recent examples of a very sharp V-shaped recovery, 2018 being the other, which I think kind of has impacted investors' psyche. So they're kind of more comfortable with the notion that you're going to have a real quick recovery and are responding accordingly. So I just think it's important to be much more agile than we had to be in the past when bear markets hit. But I still think the other part of that problem is if you put too much reliance on real current indicators of what's going on without much of a look back, then you can be expected to experience a lot of noise in the markets. There's still going to be plenty of market noise in those indicators. So hasty decisions are still likely to be punished. So in short, I don't think it's getting any easier to be a successful investor. In fact, I think it's getting quite a bit tougher than it was in the past.
No question.
Anyway, okay. And, that is the fact that we're, dealing with these, sudden changes and quick market cycles and whatnot has led to some investors be more aggressive in terms of establishing hedges. And right now, people traditionally, they would hedge, oftentimes had presidential elections, but the hedges were designed to expire quickly after the election was over, right? So you looked at hedges that ended at sometime in November. Right now, we're seeing hedges that go well past that into January and February, if you look at what's been trading in the options market. And in fact, you're the one who brought this to my attention. And so I did take a little closer look at that. And your point was well taken. So what are your views on this? Do you think that people should be establishing hedges? And if so, should they go past the election cycle? Or what's your thinking on it?
Well, with the discussions around valuation in the equity market and with the fixed income market at yields that are at historic lows, I mean, at levels that we've never seen before here in the U.S. anyway. The level of risk in the market is elevated, and hedging to some extent would seem prudent to me.
Yeah, I agree. And in fact, we at the Milwaukee Company have been having hedges, as you well know, in our client accounts for some time now. because of the increased risk. And the idea is not that you're predicting that the market's going to go lower, but as the market rises and valuation risks get higher, as we were talking about, then if you want to maintain a consistent level of risk, you need to either sell equities or hedge the equities that you have, or do a combination of both, which is, we've kind of done a little bit of both, because our clients, we don't want them to drift into a higher risk portfolio than what they felt like they had when we last talked about their investment objectives. So, but I think it's also very important to keep your political views separate from investments, and that investors have kind of a long history of overestimating the impact an election will have on the market. So I'm not really looking to hedge election results as much as I am valuation risk at the moment. The one thing that could kind of change my thinking about this, or where I might end up being proven wrong, is if the Democrats get control of both the houses and the presidency. If that happens, you could see a strong market reaction, and one, not just a temporary one. But even then, you got to keep in mind that the Republicans will always have the filibuster at hand. So there's not even then, there may not be a whole lot of dramatic market moving changes that the Democrats would be able to impose unilaterally. But as we always say, time will tell, right?
Exactly. But I mean, the potential for a tax increase is very real at this point.
Absolutely. And generally speaking, that tends to be bad for the markets, historically. And the reason for the tax, the reason people will be looking for a potential tax increase is because these huge deficits, which you've brought up, a couple of times in our discussion this morning. I mean, we've already passed, I think it is $3 trillion, is it? In the House and Senate, $3 trillion in stimulus, and another $1 trillion package is getting pushed. And even,
well, the Republicans would agree to the $1 trillion. The Democrats are looking for $3 trillion.
Oh, okay, yeah, I guess that's right. You're right. So we could get to $6 trillion, theoretically. And even the toned down or executive orders that President Trump recently signed still are estimated to increase the deficit by nearly $200 billion. So, we're talking real money there, $1 billion here, $1 billion there, and next thing you know, you're talking about real money, right?
Yeah, well, exactly.
So I guess I just want to wrap up this morning by asking you, how concerned do you think investors should be about the deficit when making investment decisions for their long-term portfolio?
Well, at some point, the money creation on the Fed's balance sheet and the deficit spending, these are unprecedented. Nobody really truly understands what the impact is going to be. The one offsetting factor is that the same types of stimulus are being provided by other developed countries to the extent that they're capable. If you look at what the ECB is doing, but the overriding concern is what's going to happen to the value of the dollar. And historically, fiscal irresponsibility bleeds into a weaker dollar, and that has inflationary impacts and negative impacts on asset valuations.
I agree, and we've seen that, right? We've seen the dollar yesterday hit a recent low, so it continues to be, the dollar continues to suffer as the deficit continues to grow. And the other problem, I think, is eventually, borrowing by the government will crowd out private borrowing, and interest rates as a result will rise. So at some point, action is going to have to be taken to rein in this deficit, or it could be a very big problem. But nobody really knows where that point is going to be. There's a heated debate amongst economists when you reach that point.
Well, you and I talked about the fact that if you go back to the start of the fourth quarter 2019, the deficit spending has just exceeded $4 trillion. And 2.2 trillion of those newly issued Treasury securities have been purchased by the Federal Reserve. So if the Federal Reserve hadn't been standing tall at their post with a non-interest rate sensitive bid, I have no idea where interest rates would be.
Well, that's right. But at the same token, those decisions to keep interest rates low now could have some serious long-term consequences. And I think it is appropriate for investors to factor that into their decisions if they're looking, years down the road.
Yes.
They want to consider that in terms of how they position their portfolios and how they allocate their assets. I think it's an important consideration. Well, with that, the time has flown, Mike, but we have come to the conclusion of our podcast for this morning. I enjoyed our conversation as always, and I'll let you get back to waiting for the cable guy. Hopefully his name isn't Larry.
I hope his pants are pulled all the way up.
Yeah, exactly. And I will get back to my tasks as well, and I will say goodbye to our viewers for this week. But before I do, I want to remind you that it's important that you do not act on any of the advice you've heard in this podcast until you've discussed it with a qualified financial professional who is familiar with your personal situation and your investment objectives. And with that, I will say goodbye and wish you all a great day and a pleasant rest of your week. Bye now.
Have a great day, everyone. Thank you.
This podcast is for general informational purposes only and is not intended to be a solicitation, offering, or recommendation of any security, commodity, derivative, investment management service, or advisory service. Nothing in this podcast constitutes or should be understood as constituting a recommendation to enter in any securities transactions or to engage in any of the investment strategies discussed. Viewers should consult with an independent financial professional or independently research and verify information presented in this podcast before acting on it.